Sawadee. Welcome back to the final part of our event today. Next, we will have a chance to learn more about investor targeting strategies. Our next speaker, Mr. Justin Reynolds, he has an extensive experience in the field of corporate governance, and he is now the Managing Director of Asia Pacific at IPREO, which is the global leader in providing market intelligence, data, and technology solutions to participants in the global capital markets. Please give a warm welcome to Mr. Justin Reynolds.
Good afternoon. Thank you very much to the SCT for inviting me, and also to Harold and Tulchan, or Angela, who invited me to come and join them as well. I trust you all had a lot of coffee, something to eat. So I've got about 3 hours of presentations, so it's going to be a long day. No. What I'm hoping to do today is really just talk a little bit about, in a sense, the other side. So there's been Harold's given his experience in investor relations in the capital markets, given a fantastic presentation from an investor relations sort of listed company viewpoint, and Angela obviously it's given it more from the communications sort of advisory standpoint. What we do at IPREO is we map and continuously track the buy side. So our interest is who are the shareholders, who's buying, who's selling, why they're buying, why they're selling, and what that means for members of the capital market. So be it the sell side and obviously listed companies, and specifically investor relations, and what it means, what you can do with that data, how it can help you. I basically say how it can help you go home earlier every single day and not work on the weekends. That's really what our sort of drive is for investor relations, as well as to make you look better in front of your bosses. So when your bosses are asking you a question, you can access this information and make yourself look better. But really it's about being smarter and executing faster, but with more intelligence, because you understand what the buy side is. So just very quickly, there are a lot of, I was joking about the 3 hours, by the way. There are a lot of slides here, but what I'm going to do is I'm going to just sort of flip over a number of them very quickly. If you have questions, I'm happy to answer them now or later, or over email in a couple of weeks. There are just a couple that I want to spend a bit of time on. So a little bit about IPREO, but just quickly, this is really the 5 business lines that we're in, and it's basically a combination of technology, workflow technology, data on the buy side, so tracking the buy side on a daily basis, the owners, and then some advisory work around investor relations that we do as well. But the advice is driven from data. It's not communication advice. We don't do any of that type of stuff. It's really advice driven by what the data is telling us on the buy side. And just to give you some idea, so about 90-something% of all new issuances go over our debt platform, and about 85% of all new issuances of equity go over our equity platform. So we're very, very ingrained into the sell side and then also into the listed companies. So what I wanted to show you a little bit using the data that IPREO has, what we normally do with this in giving sort of advice and helping with planning roadshows and targeting investors is obviously understanding who's buying and selling and why they're buying. So I'm going to come and stand down here so I can see this. Why are they buying and selling, and where the money's flowing from, and why that's important, because there's no point going to market if you can't truly, if they're selling your sector or selling your market, there's no point necessarily going there unless you're purposely decided to go there to tell your story. So understanding where the money's flowing from and to is important. So you can start with the world map, and then you can look into Thailand. And the interesting part of Thailand is you have different types of shares. So if you really want to understand what's happening in your shareholder base, you've got to understand it from the specific types of shares that you have. So these are the foreign shares. So you can split it here by region, you can split it by style, which is what we've done here for you. But you can do it by almost any category that you'd like to do it by. So here you can see that over the quarters, North America of the foreign shares has been relatively strong, and then Asia, and then sort of Western Europe. UK and Ireland, and then Western Europe. But you can look at it, if you look at it from a net change perspective, you can see that the volatility out of North America is high. So depending on which quarter, they've either been buying or selling quite heavily, whereas the volatility perhaps out of Asia is less, but still quite high, but then out of UK and Ireland and Western Europe is much smaller. So there's less buying and selling out of the UK and Ireland and Western Europe. And that's normal because American investors tend to trade a lot and European investors tend to be more long-term holders. And so that's important to understand when you're going on the road. And the same with style. So if there's a lot of aggressive growth or value investors, and you're a certain type of company, then it's worth understanding what type of style those investors are, when you're going to go and talk to them, and seeing what they're doing quarter by quarter by quarter. And then what you can do is you can drive this down a little bit further into sectors. So you can see over the last quarter in the foreign shares, the most bought sector was energy and the most sold sector was industrials. And then what you can do down the bottom here is you can look at it from the most bought security. So you can drive it all the way down into what is the most bought security. And so here for the foreign shares, PTT, exploration and production public companies, the most bought shares. And this is the change that's happened at 74.5 in US dollars is the change. So if we take that as the most bought, you can drive into it. You probably can't see this very well, but those are the owners. So you can see here, Templeton Asset Management as the institution is the largest owner. And then as you go into it, you can see the different funds. And it's important to understand your shareholder base from an institution and fund perspective, because just looking at it at the institutional perspective doesn't necessarily give you the insight into exactly who your holders are. Because under a lot of institutions, specifically as they get bigger and bigger, you can actually have index funds and actively managed funds, or passive funds and actively managed funds under the same institution. So you'll often hear from the sell side, well, there's no point meeting BlackRock because they're an index fund, or there's no point meeting Vanguard because they're an index fund.
Do you see that when they go through the nominees? Investors going through the nominees, they're going to see that.
Yeah, absolutely, because I understand your question. The nominees is what you see because you get that from the CDP, right? And that happens in almost every country. We're getting this information from the buy side. All right, so there's no, this is sitting behind the nominees.
And how often the data is being updated?
So that's a difficult question to answer. I thought you told her not to ask that question. Anyway, from an IPREO perspective, it updates every 24 hours. So our system updates every 24 hours. But it only this information only updates when we get the information. And that's really dependent on where we're getting it from and how we get it. So that's why it's a difficult question to answer. It'll range from once every 2 weeks to once a year. All right, and that's just me being very transparent, because the once every 2 weeks we get that from Morningstar, who gets it often from the buy side. Once a year will be someone like a Temasek, right? They only publish once a year, and you're not going to get that information from them more than that, from a public collection process. You could get it if you did a shareholder identification process, but in this case, so it's a wide range. But the counter statement to that is, Temasek, very big investor, very sophisticated investor, but they're not going to trade you that much, right? They're not going to be in there buying and selling, and they're probably going to tell you before they do something. Whereas Vanguard will sit there and trade you on a relative basis. So getting that every 2 weeks or every 4 weeks is good enough. And certainly better than what you get from the nominees, just watching the nominees. So the real benefit of seeing this is to understand where the actively managed money is, so that you can go to your broker and say, well, actually, I'd quite like to see Vanguard because I know they have an active fund within the wider holding. They actually have 1 or 2 active funds inside of me, and I'd like to meet that active manager. And then you can drive down even further, so you can go and look at the profile. So you can start to understand here on what is actually going on. So this is still PTT exploration, and the numbers here aren't great, but there's, I think it's 36 buyers. You can probably tell me better on the screen, on the sheet, but 7 buy-ins. So it's saying here you've got 7 new investors, 36 have bought up, 33 or something have sold, and I think it's 13 have sold out. So this is really helpful as well, because when you're planning a roadshow, you can see this level of activity, and if you're going in to see, you know, again, Vanguard or whoever it might be, you know what they've been doing to your stock over the last couple of weeks as you're walking into that meeting. And so you have the power to be able to say to that manager, oh, I saw you bought, you know, 100 shares yesterday, but you sold 500 shares the week before. And that's just a very powerful piece of information to have when you go in to meet a fund manager, because they invariably believe they know more than you do. And they're the ones who have all the questions. So it's this kind of, you know, knowledge is power type environment. But then you can also start to see, you know, what else they're buying, whether they bought your pairs, whether they bought, you know, other sectors, whether they're selling your sector. So there's a lot of other influences into their buying and selling activity. And then you can start to see it on actual, so this is Templeton Asset Management. Start to understand them as an institution, as a fund, and then as a fund manager. Okay, and then one of the benefits, going back to roadshows and targeting and making the use of your time, if you know that Alan Lamb, he's a portfolio manager here, again on the screen it doesn't work very well, but he's a manager of a large number of different funds. Okay, and one of those funds or 2 of those funds will be invested in you, but the others are not invested in you. And so with a little bit of research, you can work out whether they possibly could be invested in you, and then in the same meeting, talk to him about these other funds that he manages and why they're not invested in you, or, you know, and try and get a little bit more information out of it. So again, asking him or her questions rather than just presenting and answering their questions. And this is what we call a little bit, we call this at IPREO, we call this fund targeting. So rather than just targeting Templeton, you're targeting a specific fund in Templeton, because you've done your research and you understand that there is a chance that they could invest in you. And they're already invested in you somewhere else. So getting Templeton over the threshold of understanding your company and being happy to invest in you has already been done, because one of their funds is invested, but you could get another fund to invest as well. And then you can do it on the local shares. I'm not going to spend any time on this, but as I said, I'm happy to answer any questions that you have, other than obviously it looks slightly different. Okay, so you need to understand both these types of shares to truly understand the makeup of your shareholder base. You can do the same thing, you know, all the way through. Sorry, this one's for Harold. I noticed so Singtel, Singapore Telecommunications is the number 2 holder there of Advanced Info Services Public Company. So there you go. What Harold was telling you earlier on is correct. The data's proven it. Same process. You can do exactly the same process with those types of shares. And then the same with the NVDR, but as expected, the NVDR shares will be different. Okay, the makeup of them will be different. Where the investment is coming from, the style that's investing in them will be different, because it's a different type of share. Okay, and specifically with NVDRs, you're taking away the ownership rights. So there's a governance issue there. And it doesn't mean that there's anything wrong with it, but investors in there will have taken that into account when they invest. Okay, that they don't have ownership rights. And it's just a different type of share, and it'll act and look slightly different when you're analyzing it. So you can do the same thing here. So in NVDRs, the biggest seller was financials. Most bought security was land and house public company. Surayut Investment Management, Singapore with their 3 funds, you know, are invested in that. And then you can go all the way through and get to the actual. So Michael Bach is the fund manager of that. So any questions on that? That was a really quick run through. That normally takes a couple of hours to sort of go through that step by step by step. Any other questions? How many of you do this before you go on the roadshow? Or do you just get it from the broker? Okay, so this has been talked about a bit, the value of targeting. Again, we look at it slightly differently. We look at it from the buy side, what the potential investors or the investors are looking at. And one of the difficulties you have, and this is why Harold is such a good IRO, is because you have to sell your company. The job of an IRO is to sell the equity or the debt in the company. Right? That's a large part of it. And when the buy side is looking at you, they're using screens like this, and I'm sure you've all seen these screens. But those dots are a group of investors. Okay, and they're different types. So there's value, there's growth, there's aggressive growth. And they're looking at you as one of these dots. And your job as an IRO is to make sure you're talking to the right investors first, and then to make your dot jump out more than any other dot. And remember that fund manager met another IRO an hour ago and is going to meet another IRO in an hour's time. And your role is to make your dot jump out and really, you know, make sure that he or she buys shares in your company rather than in any other company. So understanding this and how they're looking at you is important. Okay? Because then you can truly understand how they're thinking about you, and hence answer questions in the way that shapes it around the way that they are looking at you. And the classic mistakes here are you think you're so take Taiwan. There are a lot of companies in Taiwan that believe they're a dividend play, right? That believe that that's the type of company they are. And when they tell their story, they're talking about being an income stock. But the investor that they're talking to doesn't think that. They think they're value, that they're a value stock. So immediately you have a disconnect between what the IRO is saying and what the investor is thinking. And understanding that is very, very important. And changing that mindset is important. And the reason for this, and this is where, to come to Angela's point about the sell side and corporate access, where it's not about pair analysis. It is absolutely not about looking at who's invested in your pairs and then just going to go and talk to them, or going to talk to who the sell side wants you to go talk to, because they're actually just taking you to see their clients. Because actually, fund managers are making their decisions based on financial metrics. And their job and their bonus is based on getting to a certain performance level every 6 months or every 12 months. And they need you as the IROs and the listed companies that they invested in to help them get to that. So their decisions are, you know, based on a number of different aspects, but fundamentally it's a financial decision. It's not an ownership decision, and it's not a decision based on the fact that they own your sector pair and that maybe they should own you as well. It's fundamentally a financial decision. So understanding how they're making that decisions from a financial perspective is very, very important. But the other bit, which is increasingly coming up, is what's commonly now known as non-financial or environmental, social, or governance. But again, that is not about being good to the planet or saving trees or anything like that. It's about risk. It's about environmental risk, it's about social risk, and it's about governance risk. And they're looking at it from a financial risk perspective. And so what we've done here is just to show you a couple of examples of the types of information that they're looking at. And so when you're targeting investors, understanding what they are looking at from a return perspective is very, very important. Otherwise, it's a bit of a wasted conversation. And I'm sure a lot of you have had these wasted conversations with fund managers where you just think there was no connection there at all. They were just asking you questions more about the sector or about your peers rather than you as a potential investment. And so here, I won't go into too much detail here as well, but here are a number of slides for you to sort of read through, and again, I'm happy to go through it with you one-on-one. But it's basically just looking at how funds, or firms and funds, or institutions and their funds make these decisions. And remember how, at times, the funds can make the decision differently to how the institution makes it, because they're looking for different financial returns, and they're using different financial metrics. So I think Andrew's gone through a lot of these, so I'm not going to spend too much time on this. The other bit I wanted to touch on, because I disagree with most people on this, and I think this is quite important, is hedge funds and high-frequency trading. I actually think they're very good, right? Barring the short seller or a hedge fund who's out to really attack you. Most hedge funds are long. Most hedge funds have long, short strategies. And a lot of hedge funds will actually own companies in Asia longer than the traditional long funds will do. If you look at the data and you analyze it, the vast majority of hedge funds are long investors. And the benefit of them is that they're willing to take more of a risk in companies than the traditional long shareholders. So I think you should be speaking with both. Obviously, hedge funds are a different type of audience, they're a different type of investor, but they're hugely beneficial because they are willing to take more risk, so they're more likely to invest in you faster, but also they provide liquidity. And for your long funds, like an Aberdeen, to buy into you, you have to have a certain amount of liquidity, otherwise they're just not going to do it, because they want to know that they can come in at the right price, and that if needed, they can exit at the right price. And to do that, you have to have the liquidity. And your high-frequency trading and your hedge funds provide that liquidity for you. Because if you have big investors that come in and take big chunks of your shares, and then don't do anything with it, they suck the liquidity out of your shareholder base. The other reason why these are important is they help set valuation. The more liquid your stock, the better your valuation. And that's the other reason for it. So yes, there are high risks to this, to courting hedge funds. There is a much higher risk to courting a hedge fund or playing the high-frequency trading game than there is to just talking to your traditional long-only, genuinely friendly funds. But this is what investor relations is all about, right? And so I just wanted to run through this quickly with you because I think this is something that needs to be taken into consideration. So higher high-frequency trading equals lower institutional capture rate. So the institutional capture rate is something that IPREO created to monitor the difference between owners and trading. So one of the things that investor relations should be looking at is who are my owners and who are my traders, and what's the percentage difference between my owners and my traders. So your traders can be me, just day trading, in a stock. It can be high-frequency traders, could be hedge funds, but it can be quant guys out of BlackRock, right? BlackRock is now one of the largest quant investors in the world. Most people think BlackRock is a friendly index investor. They absolutely are, but they are also one of the largest quant funds, quant institutional traders in the world. They're also the most, they're also the institution that goes short on shares the most. So when you hear the word shorting, most people run for the hills and think that there's a big, bad hedge fund coming to get you. Well, shorting is actually a very natural process of investing by the buy side. And BlackRock is one of the biggest shorters in the world, right? So understanding all of this is very, very important. But the main point here is that you need liquidity to get valuation, and you need liquidity to have Aberdeen buy into your shares. And you get that through hedge funds, you get that through high-frequency trading. Because institutions are always the price makers, all right? So they will prop up your price, and the high-frequency traders are the price takers. And that's the danger of playing this game. But I just wanted to run through this quickly. To come to Angela's points and communication, through very good communication, you can make this work to your advantage. So this is what you commonly get around high-frequency trading, and you can put this to hedge funds as well, is around, I can't control it, it's computerized, there's nothing I can do, hedge funds don't listen to me, they're always looking to attack me, etc., etc. And that is true, I'm not saying that's not true, but through a really good communication program and understanding who your traders and your owners are, you can control this to some extent and make it work for you rather than letting them run the show. And so the way that you do this in a nutshell, if you start here, so that the IRO needs to communicate the company investment message effectively to the market. Okay, and the more you can do that, and the more effective it can be, then the better it is. The market will understand your company message, right, because it is clearly communicated. And then the volatility in your stock is reduced because the uncertainty has been removed. Remember, it's uncertainty that people don't like, and it's uncertainty that the high-frequency traders and the hedge funds that are looking to make a quick gain are looking for, because they can do that in uncertain markets. And then the high-frequency traders will move out. They'll go somewhere else where the volatility is higher, because through that clear messaging that you're doing, you can take that volatility out of your stock, and they'll move on to someone else's stock. Now, the way to understand that is to truly understand who your owners are, because by talking directly to who your owners are, to exactly who your owners are, is one of the key ways of making sure that your message is getting out there. And so what I wanted to do is to show you a few slides on this. So, understanding on a daily basis who's buying and who's selling at the firm and the fund level is very important, and who that manager actually is. And keeping in contact with them, as Harold was saying, by email, by telephone, by video conference, not just on the NDR. The NDRs are very important, but just constant communication with them and staying in touch with their top owners is very important. But also then to understand what they're doing with your peers. So understanding how they are, whether they're buying and selling your peers is important as well. Because that puts you in a position of power, to understand that when you're talking with the fund manager or the portfolio manager, is to understand what they're doing with you and what they're doing with your peers from a buying and selling perspective. But also from a roadshow and a targeting perspective is understanding what's happening from a sector base. So if you're decided to go on to go and visit some shareholders in Europe, say, and you're off to meet your shareholders to maintain the relationship with your with your existing shareholders, it's worthwhile understanding what that part of the market is doing in regards to Thai-listed stock, your sector, or your sector in Asia, so that you understand that as a background before you walk into those meetings. And then the other one is to understand, and again, these are helping you think like the buy side thinks. So this is a weighting chart. Is to understand how they are moving in and out of sectors. So how that institution or that fund is moving in and out of sectors on a quarter by quarter or a month by month basis, so that you have that information and you have that power when you're going into the meeting with the shareholder or the potential shareholder. These are just different ways of looking at it, but the more that you can have access to this information, there are IROs, for example, that I've seen who've gone into a meeting with a shareholder and had this information on their iPad in the meeting, and they're looking at it during the meeting and referring to it when speaking with the fund manager or the portfolio manager. And that was really it.
Is there any question? If not, I would like to ask some questions first. Okay. You mentioned about hedge fund. You said that hedge fund is not necessarily bad for the company, and you said that they normally hold Asian stock longer than others. What is the reason behind that?
The reason behind it is that hedge funds make more money than index funds, and hedge funds generally make more money than actively managed fund managers. So if you're a sovereign wealth fund, if you're Abu Dhabi sovereign wealth fund, or Norges, or not Norges, but if you're a lot of the Middle Eastern sovereign wealth funds, but also Korea, the big pension fund in Korea, Khazanah, they're all giving money to hedge funds to manage on their behalf. So the other thing to remember is that the money might be owned by someone and then managed by someone else. So understanding that relationship is important. And increasingly, the sovereigns, specifically from the Middle East, have been giving their money to the hedge funds because the hedge funds make more money. They get better returns. Because of the way they undertake their management of that money, they get better returns. So the sovereigns have been giving them a lot more money to manage. But what they've been saying to them is, we want you to change your trading strategy. You can't be short all the time. You have to have long positions, because you don't want to get a bad name through doing this. So we want the returns, but we also want you to be a little less aggressive. And so it's changing for the hedge funds who want that money to manage. They have to change their strategies. And that's really what's driving it. I do have some slides which I'll send through to you, and you can share them. But it's been a dramatic shift in investment, and it's the reason why we now say that hedge funds. So, and I'll give you another example. Specifically, we've been talking about Singapore. So Elliott, as I'm sure some of you know, is a very, very aggressive single fund activist hedge fund. Most people, when you say to them, Elliott, most of them will remember that Elliott held up an Argentinian ship to make sure that they got paid by Argentina on their bonds. So this is the type of activist hedge fund. They get some very bad press because they can and they do become incredibly active over certain things. But they have 4 or 5 holdings in Singapore where they have held for over 3 years. All right? So they do both. But they are managing money in a very long-term perspective. But they also look at opportunities and have a go at the opportunity. And so it's understanding that difference is very important, and that's where the data can come in to help.
Thank you. Is there any more questions? Okay. If not, thank you very much for your presentation.
Certainly.
ครับแล้วก็ในช่วงต่อไปนะครับจะเป็นการบรรยายในหัวข้อ How to prepare for an international roadshow นะครับโดยวิทยากรท่านต่อไปนะครับเป็นผู้ที่มีความรู้และความเชี่ยวชาญเป็นอย่างยิ่งในเรื่องของงาน IR นะครับปัจจุบันท่านดำรงตำแหน่งเป็นผู้อำนวยการใหญ่สายการเงินบริษัท BTS Group Holding จำกัดมหาชนและท่านยังดำรงตำแหน่งเป็นประธานชมรมนักลงทุนสัมพันธ์แห่งประเทศไทยนะครับขอทุกท่านปรบมือต้อนรับคุณสุรยุทธ ทวีกุลวัฒน์ครับผม